Compass co-founder and CEO Robert Reffkin joins us now. Market's not that impressed, Robert. Stock's down 14%. It's had a nice run-up this year. What was your main message?
Yeah, I can't control the stock market, but I can control our expenses. And in the second quarter, we grew market share, we grew margin, we grew EBITDA, and we've proven that in the worst of markets, we can be free cash flow positive, generating over $50 million in free cash flow. We turned promises into results. We said we'd bring OPEX to $950. We said we'd be free cash flow positive, and now we're saying that we're going to bring OPEX to $900 million in 2024 and 2025. And when the market recovers, our expenses won't, and the result will be significant free cash flow to investors.
Where are those cuts coming from in the business?
And so there's no incremental program. It's just ongoing in terms of vendor management. There are a lot of vendors that we have that we don't need, and more offshoring and outsourcing of some of the roles that we've already identified in the past.
The revenue declines. Is that sales volumes falling? Is it prices? What explains that?
It's both transactions and price, but more transactions. Transactions are down approximately 20% year over year, and the other delta is price. That's the weighted average price of a listing, although prices in the country have gone up every month so far this year. For the Compass portfolio, we tend to be more weighted towards certain high-end markets like California that haven't been doing as well.
We talk about people sort of with these velvet handcuffs with low fixed mortgages, but there has been some survey work that suggests they're interested in maybe listing one day. What do you think cracks that? Is it unemployment where they have no choice or something else?
Yes, their buyers have accepted 7% mortgage rates as the new normal, but sellers haven't. When you have 30% of homeowners locked in at 3% or below, you have 70% of homeowners locked in at 4% or below. They consider that a financial asset and don't want to lose it. So the delta between 4 and 7 is just too much for too many people. The current view is once it gets around 5, 5.5, we'll see a significant unlock of inventory.
So, Robert, when you talk about the market basically going sideways from here for some period of time, which obviously is not exciting investors, is it just rates that are going to change the dynamic?
Rates are the key issue that will change the dynamic. I believe once mortgage rates get below 5.5 in a sustainable way, that's when the market will really recover.
We're pushing 8% now, going the wrong direction.
You could be waiting a long time.
We could be waiting a long time. And so I think that's what the market's realizing, is that next year could look a lot like this year.
What about which markets are hot and which ones are getting particularly hit? Yeah, especially after all the weird COVID dynamics.
I'd say that the hottest markets are still the warm weather, low tax states. So you have the Carolinas, you have Texas, you have Florida. But new development continues to be the hottest of the hot. People want things that are move-in ready. They want to pack their bags and go from New York to Texas, California, Florida, and just drop them off. They don't want to redevelop homes.
But can developers get the financing they need right now to put up those kinds of apartment buildings, for example?
So that's one of the silver linings. It's a great time to be a developer or a home builder because prices are increasing, and prices are increasing because of the rate lock issue. There's not enough inventory in the market, so buyers need to pay the right price in order to get the seller to list. And so we saw 2 months ago the home builder sentiment turn positive, and they had the largest number of housing starts since 2016.
Although the Journal's got a piece out today about mortgage real estate trusts turning off the spigot in terms of new loans. Is that worrisome?
It is worrisome, but developers also giving buy downs to home buyers by 1 to even in some cases 2 points from existing mortgage rates.